Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 12th of March. I'm Daniel Lam, your host for the podcast. The February US CPI printed in line with expectations. Headline rose by 0.3% month-on-month from 0.2% and was steady at 2.4% year-on-year. Core, meanwhile, is steady at 2.5%. Now, under normal circumstances, a tame CPI print and a weak February jobs numbers would have raised the odds of Fed cuts, but not this time. This CPI release is based upon numbers before the conflict in the Middle East. Now, lower oil prices had partially offset tariff-driven inflation last year, but now this offset is gone. Higher energy prices will be lifting inflation in the coming months. And commodity shocks do transmit faster than business cycle shifts. So, for example, commodities adjust faster than services, which are driven by slower moving variables, such as housing and labor. Goods do carry a smaller CPI weight, but they're extremely volatile. Now, how long would this higher energy prices last? That's the key question in virtually all the conversations that I've been having with external and internal clients alike. The key factor is the implicit closure of the Strait of Hormuz. While US officials have signaled the war is nearing an end, Iran has continued escalating or signaling readiness to do so, with reports of mining in the strait and ships being hit. Now, the IEA has announced a joint release of 400 million barrels of oil from members' strategic reserves. But the price of crude oil has been staying firm. Yes, the move from the IEA is supportive, but such releases can only buy time and don't resolve the disruption of traffic through the strait. And oil analysts are saying that this amount is only good enough to cover for 3 weeks of further disruption. If transit stays constrained and regional infrastructure is periodically targeted, there's still some upside risk to oil prices. We need to see a sustained decline and real de-escalation in the tensions in order for oil prices to come down in a sustainable manner. Thus, we continue to highlight the importance of having your hedges in place. Gold continues to enjoy short-term safe haven demand, as well as structural tailwinds, such as the buying from central banks. Investors can consider adding in tranches at the current level, around 5,000, and also at 4,800. US Treasury inflation-protected securities, i.e. TIPS, is another reasonable choice to prepare for high inflation in the near term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.